What an exciting year 2025 has been. As a rule, we as investors don't like too much excitement. We value predictability above all else. With Donald Trump in the White House, we had none of that. And still the global economy and businesses displayed remarkable resilience in this environment. The result were strong returns across virtually all asset classes. At the beginning of the year, we would not have expected such an outcome. As so many, we feared the consequences of the implementation of key policies, priorities announced by the incoming US president. And Trump did shock the world on Liberation Day with the announcement of sweeping tariffs. Equity markets duly cratered. But what came next defined much of 2025. The president reversed course, pausing the tariffs and opening the way for negotiations. Markets in turn recovered quickly and never looked back. Businesses and investors accepted a degree of uncertainty and refocused on fundamentals, which remained robust. While the tariff and trade wars lost in saliency, monetary policy moved again into focus. As the feared sharp rise of inflation did not materialize, the US Federal Reserve resumed easing policy in September for a total of 3 rate cuts in the year and down some 175 basis points from the peak in 2024. Other central banks also eased, creating an overall positive monetary backdrop for the global economy. The fact that the Bank of Japan moved in the opposite direction may be a story for this year, but had no impact in 2025. 2 other factors were stimulative for the global economy. The weaker US dollar, which lost some 10% in trade-weighted terms, mainly ahead and in the immediate aftermath of Liberation Day, and higher OPEC plus oil output, which drove crude oil prices down, were particularly positive for emerging markets whose assets outperformed those of the developed world. Finally, gold continued its incredible rally, gaining more than 60%. The rally of gold and other precious metals was symptomatic for a world which is looking to hedge the risk emanating from the US, which seems to have turned its back on the global order it itself helped to create some 80 years ago. The global economy should do just fine in 2026, and we are constructive for investments as well. Technological innovation in US policies may have started to reshape the post-World War II order, but these forces are not pulling in completely opposite directions. The combined vectors will continue to push the world economy forward and up, and maybe not in a straight line and with some bumps, but up all the same. AI and technology in general will remain a main force of change and disruption. More generally, though, 3 factors underpin our positive outlook: accommodative monetary policy, positive fiscal impulses, and greatly reduced headwinds from erratic US trade policy. For the US, the recession risk remains low despite some weakness in the labor market. Growth should actually accelerate after a soft patch as the AI story broadens out. Moreover, with the midterm elections looming, US fiscal policy will turn stimulative, and the administration will do all it can to boost consumer confidence. Europe will also continue to expand, with support coming from German fiscal spending and already low interest rates. The best economic performance, however, we expect from emerging markets. Most of these economies will continue to benefit from the weaker US dollar, lower rates both in US dollar terms and also in local markets, and low oil prices. China will outgrow the US one way or the other and challenge its technological leadership, while India will most certainly retain the crown as the fastest growing major economy thanks to its vast domestic market. The global easing cycle has also some more room to go, again mainly in emerging markets. The US Fed will wait for more data before possibly cutting once or twice from mid-year onwards. We doubt that the new Fed chair, whom President Trump should be announcing shortly, will be able to dominate the FOMC quickly to cut rates even more. A renewed attack on Fed independence and undue pressure on its policymakers would be a major risk for financial markets. The US dollar, already the weak link in the current US policy setting, would take another hit. Talking about risks, we should also mention AI. While we are not in the bubble camp, any major disappointment from the hyperscalers and other key players in the AI theme would shake markets. Moreover, US growth, which benefited materially from investments in this space in 2025, would also take a hit. We are in a new world. Policy uncertainty remains unusually high, especially in the US. The latest developments in Venezuela also suggest that geopolitical risks will stay high, and they are generally very difficult for investors to navigate. What to do in such a context? The tried and tested way is diversification across asset classes, markets, and currencies. While we remain risk-on and favor equities over fixed income at this stage, we recommend spreading exposure more widely, adding European and especially emerging markets investments, which offer both lower valuations and currency diversification. The same applies to sector exposure. We continue to like technology, the heart of the current investment boom and economic transformation. However, other sectors will also benefit from the adoption of AI, while secular demographic trends will favor healthcare, a sector which started a tepid recovery in 2025. For those focused on fixed income, we recommend adding some duration by moving out of money markets into quality bonds with a medium duration. Credit spreads are arguably awfully tight, but credit risks, if and when they materialize, will be most painful lower down the rating scale. Hence, we are not buyers of high yield. In general, though, fixed income investors face much reduced returns following the latest monetary easing cycle and higher risks as debt levels have increased around the globe. There is also a plausible scenario where the expected productivity enhancements due to AI can lead the US economy to higher trend growth. In such a case, the Fed may not cut at all or even be forced to raise rates to contain a booming economy. Finally, we recommend keeping an allocation to gold, which will continue to serve as a hedge against multiple risks. In summary, the global backdrop looks quite solid for investors. Stick to your chosen strategy and remain invested. But as always, we all should be ready to change our views and positioning if facts change. Good luck in 2026.